Let us look at one more problem of calculating the average profits. Like I told you earlier in one of the previous videos, average profits are a sum total of your super profits and the normal profits. On 1st April 2015, an existing firm had assets of rupees 1,50,000, including cash of rupees 10,000. Okay. Its creditors amounted to 25,000 on that date. The firm had a reserve fund of rupees 20,000, while the loans showed a balance of rupees 55,000. If the normal rate of return is 15% and the goodwill of the firm is valued at 44,000 at 4 years purchase of super profit, find the average profits per year of the existing firm. So what is happening here is you're given certain set of assets and liabilities which can help you find the net assets of the firm. Applying the normal rate of return, which is also given to you in the questions, you can find out average profits, right? Then you're also given the value of the goodwill, which is calculated based on the super profits. So you can calculate the normal expected profits through this data. You can calculate the super profits using this data and then combine the two to find out the average profits per year of the existing firm. Let us do that. So like I said, the average profits is equal to the normal expected profit plus the super profit, right? So first let's calculate the normal expected profit. What are the net assets? For the net assets, you're given some data. Let us just go through that one by one. The assets are 1,50,000 including cash of rupees 10,000. This data is actually redundant. Cash of rupees 10,000. It doesn't matter because when the total asset is 150, it doesn't matter whether cash of 10,000 is included or building is included or whatever. Right? So your assets are 1,50,000. The creditors are 25,000. Reserve fund is 20,000. Creditors are 25,000. Reserve fund. We've assumed that this reserve fund is towards meeting of some particular liability and therefore it's considered as a liability. 20,000. Then the loan is 55,000. So when I reduce all these liabilities, the one in the bracket are the negative numbers from 1,50,000, right? What I get is 50,000. So the net assets of the firm is equal to 50,000, right? You are told that the normal rate of return is 15%. So how much is the normal expected profit? It is equal to the normal, or actually the net assets into normal rate of return, or 50,000 into 15%, 7,500, right? So part one is resolved. Let's go to part two, which is the super profit. You're also given that the goodwill of the firm is valued at 44,000, which means the value of the goodwill is 44,000 at 4 years purchase of super profit. So when I look at the calculation of super profit, my goodwill is equal to 44,000 and this is equal to 4 times the super profit, right? Or in other words, my super profit is equal to 44,000 divided by 4, 11,000, right? So my super profit is 11,000. My normal profit was 7,500. I needed to find out the actual profits during the year. That's gonna be 18,500. Right? So my average profits goes to 18,500 and that is the requirement that I had to meet in this question.